Todd, are you back?
Terry, I'm back.
Okay. Well, we've got about 36 on board, Todd, and I'm going to just give it a couple of minutes before I begin a presentation. So
Perfect.
give everybody an opportunity to get on board. And hopefully we get a great turnout for you, Todd, because I know you've got a great presentation planned. I have seen it. It's exciting, it's relevant, and the offer you're going to make to us, I think is really going to be compelling. So I look forward to it, Todd.
Well, you just set the bar there, Terry, so thanks a lot. We're going to have fun. We'll have a great presentation today, so I'm looking forward to it.
You know, so it's a couple of minutes after noon, and I'm just going to begin with a couple of announcements and maybe a little bit of commentary. First of all, I want to welcome all the participants. Thank you for being on the presentation. I'm sure you're going to love today's presentation, and hopefully it'll benefit you in a manner that goes to the bottom line, make you more money. So, well, let's get down to the serious business. The Financial Times has a story about what it calls the Disney Parks Indicator. It's a bellwether economic indicator for the post-coronavirus world. In 2019, Disney Parks accounted for 45% of the Mouse's operating profit, but just 37% of their revenues, which speaks to the profit margins generated by theme parks. Disney parks from Tokyo to California remain closed. How brutal can it get? Research firm MoffettNathanson estimates profits from this segment will collapse 65% this year. The story points out that a visit to Disney, and in particular Florida's Disney World, requires that a consumer does everything they are not doing right now. They need to feel comfortable about their future income enough to blow about $1,500 per person on a week's trip. And in a recession, we know that consumers tighten their belts. That means less spending on discretionary items such as holidays, car upgrades, and eating out. If they don't go to Disney World, they're also not spending money on the flights to get them there and on all the other ancillary expenses. Then, of course, there's the fact that being at a theme park involves being crowded with strangers in tight spaces and perpetual contact with others who are from all over the world. Disney's parks have all the ingredients to make it a bellwether economic indicator for our post-coronavirus world. Keep an eye on that, because I really believe that that's a very true statement. A few short years ago, the Florida chapter assisted our fellow CCIMs in Puerto Rico following the devastating Hurricane Maria by sending generators and supplies. The Institute partnered with us, and the help was much needed and appreciated by our Puerto Rican brethren. Lately, I've been pondering where and how best CCIMs can contribute to the recovery and alleviate the misery of the less fortunate. As I watch the newsreels night after night, I pine when I see families standing in line in their autos that are miles long with waits of 6 hours or more to get a basket of groceries. People are hungry, and in this great nation of ours, it pains me to see food being thrown away by farmers, growers, livestock farmers, processors, and producers because of disruption to the supply chain. My charity of choice is the World Central Kitchen, founded by Jose Andres. Jose quotes John Steinbeck, "Whenever there's a fight so hungry people will eat, we will be there." You can donate to World Kitchen at www.worldcentralkitchen.com. It is a cause that I encourage CCIMs worldwide to donate to, as the benefit goes to those most in need. And having said that, we're going to bring on Todd Kuhlmann, our presenter. And Todd, go ahead with your opening slide to our sponsors. We want to thank our sponsors, Wells Fargo, CBRE. If you're on board today and would like to speak up, now would be a good time to acknowledge it and say a word on behalf of your companies. We appreciate our sponsors. You're an integral part of the success of the Florida chapter of CCIM. And because of you, we're able to bring you great presentations like today's. I want to give a short bio for Todd. He's began in Austin in 1988, and he's been in the commercial real estate business world since 1991. He had a company called KC Capital from 1995 to 2009 that specialized in CMBS loans and did over $1 billion in lending. He received his PIN in 1999. He's a senior instructor for 101 and 104, two of our core courses. And for 2 years, he served as a VP of CCIM Tech and acquired a lot of knowledge there. Of course, that's powered by Esri, and a lot of you saw our Esri owner and presenter at San Diego this year. And he is a founder and the creator of TheAnalyst Pro, which is just a great analytical program, a bit of an offshoot from our site to do business analyst, but with a lot more intelligence, and it'll really help you make a great presentation and evaluate the feasibility of moving forward with a project. Having said that, I'm going to turn you over to Todd. I'm pleased, I'm honored to have Todd on board with us. I've seen this presentation, it's truly great. And Todd, you have the floor.
Wonderful. Thanks, Terry. Thank you, everyone, again, for being here. Just to kind of go into a little bit of what Terry had introduced me with. When I was working with CCIM Tech from 2009 to 2010, basically for 22 months, I actually went to 52 different chapter locations around the country, including the Florida chapter, doing a 7 or 8 hour hands-on high-tech class on how to use demographic analysis, financial analysis for commercial real estate. And the feedback that I received at every stop I went to was, Todd, it needs to be simple for us to use. It needs to make our lives easier, more robust, make us look more professional, but not have it so difficult that it's going to take us hours and hours to put together a presentation. And so I took all this feedback from a lot of my peers, my CCIM peers out there, and we started, as Terry mentioned, TheAnalyst Pro with CRE Tech. And so what today's session is going to be is it's going to be really kind of a, I'll put up the next slide here. I'm going to take you basically through, I won't say a 101 class, but if you've been to a CCIM 101 class, you know there's 32 hours of education over a 4-day period and then a nice 4-hour exam at the end. We're not going to have a 4-hour exam at the end. We're not going to, Terry told me I couldn't talk for 32 hours, but we're going to go through a tremendous amount of financial analysis on a property. I've got a case study property we're going to do that on. We're going to look at the impact of financing on that investment, which basically is the first 3 days of a 101. We're going to analyze the market and location analysis for the property. That's a 102 class. And then we're going to put together a full offering memorandum on the property. Terry says I have 45 minutes to do this. The way we're going to do this is we're going to go through and we're going to really focus in on the concept of the financial analysis, the financing, the location analysis. And for some of you, and hopefully for most of you, it's going to be a good refresher into what you already learned when you got the CCIM designation. But instead of us manually going in and using, let's say, an Excel spreadsheet to do these calculations, we're going to use TheAnalyst to do what I call the heavy lifting. Let it do the mechanics for us so that we can now focus our time on simply looking at the concepts, which is very much the most important part, especially when you're sitting across the table from a particular client and wanting to work with a client and explain to them what these numbers mean and if this is a good investment or if this is not a good investment for them. we did have, we presented this in San Diego at the conference, the same one that Jack Dangermond was at with Esri. In fact, right after Jack spoke, we did a breakout session. And so this is a summary. This next 45 minutes is going to be a summary of what I did present in San Diego live. And then the CCIM Institute, through the CCIM Insider, did come up and run an article on that particular presentation using the case study that I'm going to show you today. It was an article written by the CCI magazine for the winter 2020 edition that talked about how leverage can boost your equity return, your equity yield on that investment. And so we're going to go through and basically live this article and show you how this article plays out. And then I've got a link to the article. One thing that Terry and I talked about, Mary and I talked about before the session started today was I will definitely take these slides and I'll share these with you so that you have them. I'll send them to Mary after today's presentation is completed so that you have a copy of these slides and then you can grab these links. Let's also be a good case study for you to practice some more on. Now, what I like to do when I teach, I like to drive right into a case study and a case study setup. And so in our case study setup, and if you think about some of the classes you've been to where you're doing more of this hands-on case study work, this is exactly what we're going to be doing in this session today. We're going to take it from the beginning to the end, from a client need all the way to the analysis of different properties for that particular client and identifying what properties are going to fulfill that client's need. I've got a good CCIM friend of mine. He's a past CCIM Institute president. He's over in Baton Rouge. His name is Carl Landerneau. Many of you know him, and I know, Terry, you know him very well. Anyway, Carl's near and dear to me. He has been a user of our system since day one. Since 2011, 9 years ago. But not only that, but Carl is just an amazing friend of mine and a mentor of mine. And so when I wrote this case study, I actually worked with Carl in setting this up. And then Carl and I both presented it to the CCIM convention or conference in San Diego. That was just a blast to be able to sit next to my friend and teach this. But here's the case study. Here's the setup. Carl contacts you and he's looking for an investment property. This is your first deal with Carl, but he is wanting to invest $6.75 million of equity, so cash, as long as you can provide him a 10% annual return on his money. Think about that. How many of you have had that Carl calling you saying they want a 10% annual return on their money? Carl plans to own the property for 5 years and wants a strong market that is growing. So what we do, we come in, we identify a property. And in this case, I identified a property here in Central Texas. I'm in Austin market, as Terry mentioned. So I identified a property, a proposed property in Central Texas. This is a proposed 60-unit apartment complex. So our goal in our analysis is to come in and analyze an as stabilized property to determine if it's going to achieve Carl's 10% annual return. He wants annual return every year. The land is available, and the land plus the construction cost, all the soft cost, hard cost, are $6.5 million. We add to that a 2% cost of acquisition when Carl buys the property. So this is going to be his attorney's fees, his closing fees, recording fees, title fees, those types of things that he would have when he buys the property. Now we're going to look at this and say, well, Carl's going to own this property for 5 years. So his cost of sale or disposition 5 years from today, we're going to say it's going to be 5%. So you're going to have a broker that wants to get a commission on the property. And again, you're going to have your recording and legal and closing fees that we're going to say is going to cost us 5% of this. Now I'm putting up these numbers. I'm trying to set this case, but I'm going to analyze some of these numbers for you and put them up in a couple slides. Now, we've got to have income on this property. So here's the proposal on the 60 units. We're going to have 20 of the 60 units be 1 bedroom, 1 bath. 20, we're proposing to do 2 bedroom, 2 baths. And then another 20 to be 3-bedroom, 2 baths for a total of the 60 units. And you can see here on the unit matrix that we put together what the monthly rent would be, the square footage of the unit, the monthly rent would be, the monthly rent per square foot, and then the total annual, what I call potential rental income on the property. Potential rental income, 100% occupied market rents, and you can see over a 12-month period, this would total $900,000. For our analysis, we're going to anticipate that our income would increase. And I usually call this a CPI index. I'm not sure what the CPIs would be today, but we'll call this the CPI index increase. I usually use about a 3% per year increase in our rental rates. And then we do have some laundry income. So we have a laundry mat on site that we're going to allow, and we're going to say this is going to generate about $4,000 a year in additional laundry income. And again, we'll take it up, but we'll increase this at only 2% per year. And then our expenses on the property. And this is when I'm coming in and I can itemize the expenses. I can say, here's our real estate taxes, our insurance, our management fees, you know, all the expenses. And I'll show you how you can itemize these. But we're going to make this simple. We're going to say the expenses are going to be approximately 40% of the total collections we have on the property, 40% of the gross operating income on this property. The vacancy on the property, we're going to underwrite, and this comes back to my Wall Street days, as Terry mentioned. We had to always underwrite a minimum of a 5% vacancy for multi-tenant, multifamily properties, those types of properties. So we're going to do the same. We're going to underwrite a 5% vacancy. Now, my local market is actually a pretty tight market. This Austin market's about 97% occupied. So the market itself is a little bit stronger, but we're going to use the minimum underwriting vacancy that an institutional investor would use, and that's typically 5%. And then finally, we're going to talk about our replacement reserves. So these are reserves for replacement, such as AC units, roof structures, any component item that we may have to replace. And again, this kind of comes back to institutional underwriting. We're going to say $250 per unit per year is going to be set aside in a reserve account so that we can pay for those one-time expenditures, repair items in the future. When Carl's ready to go sell the property, we're going to say market cap rate. Now, today's market cap rate on apartment complexes in Austin are anywhere from 5.5% to 6%. We're going in very conservatively for Carl and saying we're going to have a 7.5% disposition cap rate. And if you listen to Casey Conway in some of the previous economic sessions that he's had, I know with the Florida CCIM chapter as well as the CCIM Institute, we are looking at options of cap rates increasing and the cap rates going up. And so I'll talk a little bit more about that as we get through today's session. And so institutional investors are underwriting cash flow analysis deals and investment cash flow properties with a disposition cap rate or a sale cap rate higher than cap rates prior to the COVID-19. So this is something to keep in mind. Now let's look at our steps that we have involved for Carl. Remember, he had $6.75 million. So our first step is to come in and identify, well, how much is this going to cost Carl? What is his initial investment to buy this property? So we start with the purchase price of the property plus those acquisition costs. If Carl was going to finance the property, we could subtract the mortgages and then add our loan fees to that to get his initial investment. In the first scenario here, we're going to be looking at Carl coming in and paying all cash for this property. So his initial investment in the property is $6.5 million, and his acquisition costs are $130,000, or again, that 2% of the acquisition cost. So his total initial investment is $6,630,000. That's what he's going to have to walk into the closing agent with. That's lower than his $6.75 million. So this step one initial investment, this property would qualify under his criteria. But the next criteria was 10% annual return. So to calculate the 10% annual return, I'm going to start with our cash flow model. This is a universal cash flow model, but this is the same cash flow model we use in CCIM land. We start our cash flow model, and this is our annual cash flows on the property, with our potential rental income. Again, as I mentioned to you before, that's 100% occupied at market rents. That potential rental income on our apartment complex, as I showed earlier with our unit matrix, is $900,000. We subtract the vacancy and credit loss to give us what we call our effective rental income. Now, these are annual numbers. So when we're calculating an NOI, it's over a 12-month period. So what we're doing is we're looking at the total rental collections on this property over that 12-month period. Then I can add my other income, AKA my laundry income. You may have parking income, signage income. All of this is other types of income you may have on your property. We add the other income to our effective rental income to obtain our gross operating income, or GOI. The GOI, think of it as this is the total deposits that you physically deposited over that 1-year holding period, over that 12-month period. So that's your gross operating income. We then subtract out our operating expenses, and these are going to be your normal recurring operating expenses that you have on the property. I mentioned to you before, your real estate taxes are obviously a big one. Property insurance, property management fees, normal repairs and maintenance, normal things like repairing doorknobs, repairing lights, maybe painting, those types of things are going to be normal repairs and maintenance expenses on the property. Utilities, landscaping, all of these items are operating expenses. I take our gross operating income, subtract it from our operating expenses to get a very important number. This important number is called our net operating income, or NOI. And there's some very important things that NOI does for us. I'm going to get to that here shortly, because every dollar of NOI can relate today to anywhere from $10, $15, even $20 of property value on an income producing property. So this NOI is a super important number to determine value of property. I subtract, and here's one thing I'm going to slow down a little bit on. NOI is also property specific. Think about this. So it doesn't matter if Terry's buying this property, or I'm buying this property, or Carl's buying this property. The NOI for all of us should be exactly the same because it's property specific. We should all be using the same income expense numbers for our underwriting of that property. And I've had people come to me in the past, and I've done a lot of financing on apartment complexes over the years. A lot of times for what I call mom and pop investors, smaller investors. And they'll come to me and they'll say, Todd, hey, you don't have to underwrite a management fee in those operating expenses because I'm going to move to the property and manage the property. You don't have to underwrite landscaping because I'm going to take care of the landscape of the property. And I look at them and I say, yes, I do need to underwrite a management fee and landscaping. And that's because if I have to foreclose on your property, I'm not moving to your property, managing it, and doing your explicitory lawn and landscaping on that particular property. So in this case, they should be paying themselves for those items, but we should all be underwriting the property and getting to an NOI that is universal for that property. Doesn't matter if somebody from New York to California to international is buying the property, that NOI should be the same. Now you go below that NOI line, and then we get specific to the investor. Not specific to the property, but we start getting specific to the investor now. So we take the NOI and we might have a loan. So we pay our annual debt service. And we make mortgage payments just like anyone else in the world. We make them monthly. But because all of these numbers and our NOI numbers are annual, then what we'll do is come in and look at the debt payments, the principal and interest payments on an annual basis as well. So I take the monthly PMT payment on the loan, multiply it by 12 to give us our annual debt service. NOI minus annual debt service gives us our cash flow before tax. We subtract our tax liability, that would be to Uncle Sam, and that would give us then our cash flow after tax. Again, all of these numbers very specific to an investor and looking at that particular investor's objectives. So looking at step 2 here, we're going to do the numbers for you. So we look at the cash flow model for the Gabriel's Overlook apartment complex. And the Gabriel's apartments, we see that we have the potential rental income, $900,000, minus that 5% vacancy credit loss. We have the laundry income of an additional $4,000 to give us our gross operating income, $859. Subtract out the 40% expenses on the property. 40% of the gross operating income is $343,600. To give us our NOI, or net operating income, of $515,400. That becomes our property's NOI. Now, we're also going to take replacement reserves and put them aside. And so we're going to set aside $15,000 a year in replacement reserves for those one-time expenditures, in case I have to replace an AC, a hot water heater, those types of things. This then gives us our cash flow before tax for year one of $500,400. Now, I forecast this. Now, again, this is something, if you remember in 101 days, we did with pencil and paper. I did it with a calculator. I did it with an HP calculator and calculated all these numbers. And of course, it took hours of time to do so. Today in the classroom, we use Excel spreadsheets. It makes it a lot faster. But I still, in a one-on-one class, will have people bust out a pencil and paper and go through and put on these numbers, because it's important, and this is the great thing about CCIM, you learn where each one of these numbers come from. Because we have 45 minutes and because we're running more of a real life scenario here, we're coming in and we're using the software to come in and analyze this property over this 5-year holding period that Carl is looking at. This gives us our 3% annual increases in our potential rental income, plus the 2% increase each year in the other income. The 40% expenses remains the same based on the new gross operating income every year. So our expenses are going up, but it's still based on that 40% expense amount. Now, here's the question I have, and I want to pause. And Terry, I'm gonna see if you can help me here. Does this property, based on the initial investment we have, based on the cash flows we have on this investment, does it achieve Carl's 10% annual return requirement? So if you would, chat it in the chat box with us, and I'm gonna get Terry a little help here. Terry, can you give me any feedback based on any chats we have maybe coming in? What do people think? Do they think this is going to have a 10% return for Carl? And again, remember, he wants a 10% every year on this investment, not just the first year.
So
let's take a look.
We're getting them in, so let's give them about a minute. And so
Perfect.
We have a no so far.
Well, and again, this take some time, take a look at this, because we definitely want to see, is this going to achieve Carl's investment objective?
So we have a depends on sales. Depends on sale. Response, we have a need projected sales price to factor that in. No. So that's another one from one of our
Nice.
participants. Doesn't appear so from the info given thus far. Does not appear so.
Right. Good.
Any
well, and
other
this
response?
is, and keep the chats coming in, but this is typically the responses that we receive. So this is very traditional for the responses that we get when we're taking a look at the cash flow of the property. Any other responses?
So we got another no.
Terry. Okay, good.
2 more no. So yeah,
Nope,
it seems that the consensus is no.
Good. Okay, well, so and usually at this point, we have people coming in and they're saying, you know, I want an answer. What is the return? And Carl's going to want to know exactly what percentage is the return on this.
Well, we got an 8.2% answer.
All right. So we have, so this is a CCIM out there. It's like, okay, Carl's going to want to know what is the percentage. And so coming in and looking at 8.2 on this. And this is again before tax on this situation, and we're doing it without financing for now. So let's take a look at this from the top. There's several different investment measures that we look at. We have the gross rent multiplier, we have the cap rate, cash on cash, and then some of you wanted us to calculate the sale. So we have the internal rate of return, and we're going to look at the cap rate versus the yield on the property as well. So there's 2 different types of investment measures out there. One investment measure measures what I call the value of the property.
Can I interrupt?
Another investment measure measures the return on the property. Absolutely. Go ahead, Terry.
Yeah, I just wanted to give you one more comment that's typical CCIM comment. Need to consider the reversion upon disposition. as well as calculating the internal rate of return. So another good response.
Perfect. Well, and that's exactly where we want to go. And this is exactly why your CCIM's out there. But 90%, and I've run across this so much, 90% of investors, think about this, are just looking at 1 year cash flow, not looking at the entire cash flow, and they're not looking at the reversion or the sale. So that's where we want to spend a little time today as well, in that reversion, in that sale. And I'm going to build this up. So I'm going to go a little bit faster, but I'm going to build this up and say, okay, we have our gross rent multiplier and sales comparison approach. Both of these measure the value of the property over a specific point in time. For those of you who don't use gross rent multiplier very much, it's typically for apartment complexes and multifamily complexes. In my days of lending, I probably used it a handful of times, but every appraisal I received would have a gross rent multiplier on it if they were appraising an apartment complex. It's very, very simple. As you can see from the cash flow model over here on your right side, it uses the first year potential rental income. It doesn't look at the vacancy, the operating expenses, the financing, or the taxes on the property. And it typically just looks at the first year, 1 year of income. So in this case, it's taking the purchase price and the potential rental income from year one, and it's calculating what the GRM is in that investment then. We put this in the handy dandy little GRM calculator. We can put 6.5 million as our value at the top, put the PRI, 900,000 at the bottom, and then what it does is it takes the 6.5, divides by the 900 to give us a 7.22 GRM. That's not a return. This is a measure that appraisers use in the marketplace to determine a market gross rent multiplier. This allows them to come in and take the market gross rent multiplier, multiply it by the potential income to get us a price or value, just like we would do a sales comparison approach with price per square foot. Next up is our cap rate. And this is one thing I get really passionate about. In fact, I have a whole hour long I do just on discussions of cap rate. I'll show you where you can obtain that 1 hour cap rate conversation because I'm so passionate about this cap rate item. Cap rate. Cap rate is the most widely used investment measure in all of commercial real estate. It uses the first year net operating income or NOI on the property. So again, it's very property specific. Doesn't look at financing, doesn't consider taxes. And while it's the most widely used investment measure in all of commercial real estate, it's also the most widely abused. And this is the issue. A lot of people are using cap rate as a measure of return on their money. But cap rate, people argue with me on this, cap rate doesn't care about your money. And I'm going to prove it to you. My definition of cap rate, I wrote this definition. I am pretty passionate about it. Cap rate is used to determine the value of an income producing property. Now, we heard Casey Conway talk about cap rate fluctuations and what's going on with the current cap rates. Cap rate is very much driven by supply and demand. Well, what's the demand for going to Disney World, as Terry mentioned right now? Demand for some property types may go down or have gone down, such as hospitality, some retail properties. Demand on other property types, such as industrial, may go up. So when demand fluctuates is when price fluctuates. Now, my little triangle right here, this triangle is NOI, net operating income. If the NOI stays the same, and what happens in this case, if the cap rates go down, my property value goes up if the NOI stays the same. However, as we heard from KC, if cap rates start going up, what happens is prices start to go down. And what's very interesting to me, and I mentioned to you, I used to work with a lot of mom and pops, you're going to have the investor go, well, cap rates are going up, so maybe my return's going up. No. Doesn't have anything to do with your return, doesn't have anything to do with your money. Basically what that's saying is the prices are going down when the cap rates go up. So keep that in mind as we come in. Now let's go back to our case study and take a look at Carl's situation. He's got this 6.75 million, wants a 10% return. We found in this apartment complex And what we're going to do is we're going to come in and we're going to look now at that reversion when we come in and sell this apartment complex. What will we be able to sell it for? And what will the return be for Carl on an IRR basis, not just a cap rate basis? So I'm going to look at the disposition cap rate for this investment at the 7.5%. Let's run the numbers, and I'm going to run this pretty quickly in the Analyst. So this is the home page for the Analyst Pro. One thing I'll mention, and Terry wanted me to make sure that all of you knew you could get 7 days free trial on this. Email me. I'll send out my email address. Email me. We'll get all of you set up on a trial on this, special pricing, anything you want right now because of what's going on with COVID. We are happy to help accommodate the chapter. But one thing we have down here on our home page of the Analyst Pro is a bunch of different trainings. And I actually have a cap rate versus cash on cash training, predicting future cap rates training session coming in. I have all these different training sessions that may be very helpful and very useful for you. I also have a training session. It's a 2-hour called Advanced Investment Analysis using Analyst Pro. It takes basically what I'm doing in this short segment and does it in more detail. And so if you have people in your office or others that wasn't able to attend this session, that may be something of value to them as well. Well, let me go in. We're going to select the analysis reports up here. We've got a bunch of calculators and a bunch of demographic analysis, location analysis tools. But I'm going to select the analysis reports and select up here investment analysis. And we're going to create a new investment analysis for this Gabriel's Court. So I'm going to put in analysis name, Gabriel's Court, and I'll create a new folder to store this in. And I'll say Florida CCIM chapter, press the save button. And we've got a few steps here. And so over here on the left side, you'll see first thing I have to do is put in the property information, income, and we'll go through each of these. So we make it very, very straightforward. And there's a help button each step of the way. Short help video as well as written and PDF help for you. The purchase price for the apartment complex, the purchase price that Carl's going to pay is going to be $6.5 million. Now that's for the land purchase plus all the construction is $6.5 million. I'm going to come down and say it's going to be, in this case, 60 units. So instead of square feet, I'm going to say property size 60 units. I usually tell people if you rent the property based on a unit basis, select units here. If you rent the property based on a square footage basis, select square feet. Retail, office, industrial properties. Obviously, you'll be selecting square feet. It actually changes the next screen, the income screen. If I select square feet, allows me to put in each individual tenant in the property if I select square feet, and do a rollover risk analysis and custom rent escalations, all kinds of cool stuff. Purchase date, we'll just keep that at this month since Carl is going to pay all cash. Now I can put in the potential rental income. We said that was $900,000, but I'm going to complicate this a little bit and say, well, let's add a unit matrix. We want to make this a little bit more detail for Carl. So we said we had 21 bedrooms and 1 bath. Those were going to be 800 square feet and rent for $1,000 a month. Next, I'm going to have 22 bed, 2 bath. They're going to be 1,100 square feet renting for $1,250. And then finally, we had the 3 bedrooms. So I have 20, 3 bed, 2 bath. You can put anything as a description on this. If you had self-storage units, those types of things, you could do 10 by 10s, 5 by 10s, those types of things as well. And that's going to rent for $1,500. So we're going to save that. The other income on the property, we had $4,000 in other income, but it was increasing at 2% a year. So we'll change that to 2%. Next is our vacancy credit loss. We said 5% vacancy, 40% of the gross operating income for expenses. This is where you could put an actual dollar amount or a percentage of the gross operating income, which is shown here, this hover over. You can also put in line item expenses. So if you want to put in real estate taxes and they're going to go up a certain amount per year, you could do that. If your property management fee was a certain percentage of the gross operating income, I could come in and say, okay, my property management is going to be 5% of gross operating income, things of that nature. Now I'm going to scroll down, and next in this section is going to also be our replacement reserves. We'll put in $250 per unit per year in replacement reserves. If you selected square footage for the property, office, retail, industrial, you could put in, 20 cents per square foot per year, those types of things. Now, Carl is not going to finance it in this particular situation. So we're going to say he's paying all cash. My mortgage section, I'm just going to leave the mortgage section blank. There is no loan, so I'm going to press continue. And when Carl sells the property, we're going to assume he's going to sell the property at a 7.5% cap rate. So I'll put in 7.5% on my sale cap rate. And now I can select the report I want to do for Carl. Well, he's going to be looking at this as a 5-year before tax. I do 5-year after tax, 10-year before, 10-year after tax as well. And then I could select different sections of the report that maybe I want to add. Maybe I want to have a nice graph that talks about the income versus expense ratios, optimal holding period, cash on cash returns. If I was doing leverage, you can see I can't select this now, but if I was doing leverage, I could do an impact of leverage analysis. I can also do an acquisition price. What if he paid more for the property? What if he paid less for the property? Disposition price. What if he paid more or less for that property as well? So once I select the items in the report that I want to include, what the system is going to do is it's going to then build my whole cash flow analysis report for Carl to analyze, not only based on the cash on cash return each year for this investment, but we're also going to look at the internal rate of return or yield on this investment based on what he could sell it for. A little thing that we do different for you CCIMs out there, a little thing that we do different on our analysis, we actually look at, well, what if he sold it the first year? What could he sell it for? What if he sold it the second year? What could he sell it for? What would the return be if he sold it the first year, the second year, the third year? Now this should look familiar because this is going to be, and let me make this a little bit bigger. This is his initial investment. He didn't have a loan, so that's going to be 0. So on our cash flow analysis worksheet, we have our 5 years cash flow analysis that we looked at before. And then we do a before tax cash on cash return each year for this investment. But here's what most of you wanted me to do. You wanted me to calculate the projected sale on this investment. And in this sale would be 5 years from now based on that 7.5% cap rate. So we could sell the property then for $7.9 million 5 years from today, minus that 5% cost of sale to give net sales proceeds of $7.5 million for Carl. When we do an IRR calculation for this, we see it gives us an internal rate of return of 10.28%. Now let me scroll down. This gives us our unit matrix on the property with our rent per square foot. This I'm going to come back to in a minute. For you CCIMs out there, you're going to love this because these are T-bars. But this shows the property T-bar, property without leverage, the financing and cost of financing in the middle T-bar, and then finally our equity T-bar. Now, because Carl's paying all cash, both the unleveraged property and the equity return are the same because we don't have financing. So still 10.28% for both of them. Our NOI change, it's going up an equal 3% per year. We put that in, and our expenses are running an equal 40% per year. Pretty boring graph because we put in 3% and 40%, but think if you had a multi-tenant property and you put in different lease escalations and different rollovers, this gets really interesting. And then your expenses change on an annual basis. Maybe you have net leases and you have some turnover. That's going to be great for you to kind of compare those. Yeah, Terry.
Todd, I'm going to stop you here for a second because we have a question and a comment. And Rick adds that cap rates include return on and return of investment. Although it considers just 1 year of NOI, the cap rate should include consideration of future income potential. More income potential and or increase in value at sale, lower cap rate, lower potential, higher cap rate. Also, it should consider immediate capital improvements. And then a question came in, and it's a very good question. In the last recession, when values went down, the property taxes went down also. Can you handle that in Business Analyst Pro, in Analyst Pro?
Great comments. And I get pretty passionate on the cap rate. I do have a video on the cap rate that goes into more detail and why I say it calculates the value of the property. A cash on cash considers the return on your property and cares about your money, and it actually does take into consideration those capital improvement items as well as your acquisition cost. Cap rate doesn't take into consideration the acquisition cost, and so that's a differential. A lot of times I'll have people say that cap rate is a return if you pay all cash, but it does come into that situation where cap rate is not looking at your actual equity investment. Cash on cash is looking at that equity investment, so that's the return. As far as the taxes go, absolutely. And I'll come in and I'll show Mark where I can come in and change the tax amounts each year. So if I want to come in and actually put in tax rate today or tax amount today, I can adjust that over a 10-year period and make adjustments, actually 11 years, because we're taking into consideration year 10 or year 11 NOI to calculate the sales price at the end of year 10 as well. So something else to keep in mind and keep in consideration. Now, what I'm going to do, and Terry, if there's any other questions, I'm going to now come back and I want to add financing to this particular property. And I want to see what the impact of adding financing is going to be to our 10.28% return on this particular investment. And so we learn in CCIM, we have this thing called positive, neutral, and negative leverage. Positive leverage is when the investment yield, my 10.28, is greater than my cost of borrowing money, my effective loan rate. So can that increase that will increase my yield versus negative leverage, well, it'll decrease. And we've got some samples right out of the CCIM 101 class that I wanted to share with your chapter members. In this particular case, this is a positive leverage scenario. In this particular example, we have a property that has an 8% internal rate of return, 8% IRR. And our cost of borrowing money in our loan is 7.5%. So as you can see, the property's IRR is greater than the loan cost, 7.5%. What that will do to our equity return is will increase our equity return to be higher than the property IRR. And in this case, if I do the calculation on the IRR for our equity, we get a 10% equity IRR, equity return, and that's an annual return. So that's positive leverage, and that's the power of positive leverage. Now, coming in and looking at negative leverage, not my favorite subject at all. Negative leverage, same property, same 8% return on that particular property, but now my cost of borrowing money is higher. My cost of borrowing money is now 8.5% instead of 7.5%. What that's going to do to my equity return is diminish it. And now my equity return, the return on my cash, is actually going to be lower than what the property IRR is. This is very important, especially in today's day and age where we have such wonderful loan rates on some of our commercial properties. And this can make a big difference for you when you're presenting a property to a client. Now, same property, same setup, same expenses, same reversion, same cap rate. But now I go get a loan quote. I get an 80% LTV loan quote with a 5% rate, 25-year amortization, and a 10-year term. We're going to pay 1 point up front on that loan to get that loan. So let me flip back over to the analyst. And one thing I want to do is go back to Mark's question real quick. So if I go to my expenses, and just go into the real estate taxes as per his example, I could come in and I could say, I could enter an amount here in the taxes. Now what that warning sign was, if I change this, it's going to do away with my 40% of gross operating income. So I'm not going to do that. But I can come in and I can put in the year one amount, and then I can put in a positive or even a negative that it would change. What you would probably want to do is come in and say, what is the total tax amount per year? And I can actually put in the actual dollar amount of those taxes for each year. And as I mentioned to you earlier, it would go for a full 11 years. Again, that's because we use the NOI at the end of the 11th year to calculate the sale for the 10th year, as you learned in CCIM. All right, let me go. I'm going to click over here on the mortgage, and we're going to add this loan in. So we said 80% LTV, loan rate 5%. Some of you are probably, Todd, I can get lower than that now. Well, I wrote this case study, you got to remember, about 9 months ago. 25-year amortization with a 10-year term, and we're going to pay 1 point to the lender. We've actually enhanced this quite a bit where you can do an assumable loan, you can do an interest-only loan, you can do an interest-only that converts to an amortization loan, you can refinance a loan, all kinds of great stuff. We're making it simple. We're making it simple here. All right, we've got our disposition cap rate coming in. I can now rerun my analysis with financing, So in this case, we're going to look at, we started with a property IRR of 10.28. What is it going to change with financing? Terry, did you have a comment?
Great question. And they say at some point, comes from Ron, please address the disposition of the reserve fund upon reversion. It's a really good question.
That is a great question. So Ron, I'll talk about that in just 1 second, because what this reserve fund, this $15,000 a year we're putting in here, I can talk to you about it from a lender perspective, and I'll tell you about it too. So let me go through this and the IRR calculations now with financing. So you see up here some stuff has changed. We've got our first lien information now, the 5.2 million or 80% LTV, which calculates our payment and annual debt service. We now have our new initial investment for Carl being $1,482,000 on this particular investment. And then our cash flows have changed because we've added in the annual debt service each year for this particular loan, coming down to our cash flow before tax and now our cash on cash return. So before our cash on cash for the first year was 8%, now it's 9.15, going up to 10, 11, 12, 13%. That's what I call a dividend return because it's a 1-year cash flow. It doesn't consider the sale of that property. It just looks at 1-year cash on cash return. Our new reversion on the property, we sold the property for the same, still the 7.5% cap rate. We do pay off the first lien mortgage balance to give us our sales proceeds before tax. If I do an IRR calculation on this, I get a 23.39% IRR. What are we talking about? Let me scroll down here. Unit matrix is the same. This is what I want to show my CCIM friends out there. We had the 10.28 on unleveraged property IRR. Didn't change. We come in, we borrow money. You may say, well, what's this effective loan rate? 5.19. Well, remember, we paid 1 point up front. So that actually increases our cost of borrowing money and our cost of funds. So we look at the total cost of funds when we're comparing the property IRR to the loan effective cost rate to see if we're going to have positive leverage. Now, because of the difference, and we literally have about a little over 5% difference between the property IRR and the effective loan rate. Because of that difference, we've increased our equity yield substantially. Our equity return, the return on every dollar of Carl's money while it's in that investment, is now 23% per year. We've increased the return by 13% from 10 to 23 by using leverage. That's the power of positive leverage on this. If I scroll down, there's another graph I want to show you. This is our optimal holding period graph that shows the optimal period to own the property to maximize the annual return. And again, assuming, what if I sold the property year 1, year 2, year 3, year 4, that type of thing. But this is the graph I want to show you when it comes to leverage. This graph will basically show the property's IRR, the blue line, and this is based on the year I sell the property. So if I sold it year 1, year 2, year 3, but also our cost of funds and our equity IRR. That's the wonderful thing. Now, let me come back to my PowerPoint presentation. See, what are we, how is this happening? How is this working? Yes.
Yeah, great question here. Came in from Mike. As DSCR is used by most lenders, can your software automatically calculate financing based on DSCR? And that's a great question. I did a little routine where I compared DSCR to LTV, and then the program selected the lower of, which would become the lending standard. Is that something that Analyst Pro does?
Absolutely. Now, you have to remember, I have 14 years of commercial real estate lending background, and so I'm pretty passionate when it comes to this. We actually have a full loan amount analysis where you can come in and just real quickly, I'll do this. This shows you just how quick you can do this. So let's say my purchase price in this case was $6.5 million, and our LTV is 80%. Now, we know that will calculate the 5 million loan. But our first year NOI, we take the first year NOI of the property, and using that first year net operating income on the property, we can then calculate the maximum loan based on DSCR or LTV, and it actually creates a 4-page report for us with a sensitivity analysis. Sensitivity, what if I change the amortization schedule? What if the interest rate changes? What if my NOI changes on this particular investment? How would that change my loan, and what loan is available? So literally with coming in and just putting in about 6 inputs, I can create a 4-page report based on that debt service coverage of that particular property as well and calculate. And it's a great report for a lender when you're giving it to a lender as well. So keep that in mind. I want to wrap up because I know I've only got a few more minutes, and then I will stick around and go through anything with as many questions as people has, because I'm not in a hurry to get off this call. I know some people looked at the top of the hour. I want to get through this positive leverage real quick and kind of explain it, and then I can come back to some of this DSCR as well. But in this case, we went from a 10.28% return to a 23% return. And a lot of people, to grasp that concept and to understand that concept of that positive leverage and make the difference between doing a deal and having a deal qualify for a client or not. And with our great interest rate climates today, this is where it becomes even more essential to understand positive leverage. And so I got a little graph here, and this is out of 101, CCIM 101, so it's a good reminder. But this graph shows, if I buy a property, let's say the property IRR is 10%, so very much like the property we're looking at for Carl, and I pay cash for the property, that represents this whole 100%. So this is my cash for this particular investment. I would have a 10% return on this investment. But if I was able to go get financing on the property, and in this case, if I was able to get an 80% loan on this investment at an 8% rate, and I know you're sitting there going, 8% rate, that's crazy. Well, I'm just trying to make a point. If I'm using this 8% rate, this portion, this 20% portion over here between the 80 and 100, well, that's my equity. That's Carl's initial investment, or that's his equity in the property. And that equity is receiving a 10% return. So you can see that. But what we have is a little arbitrage here where we come in and 80% of this, since we're getting an 80% loan, we have a 2% spread. That spread becomes our return as well. And you can imagine right now, if we've got a 5 or even a 4% loan, that spread gets bigger and bigger and bigger. The bigger that becomes, the more return that gets added to our own equity. And that becomes additional return to us. So just in this particular example, I'm showing an over 18% return with a 2% spread between the property's IRR and the effective loan cost. But think about today, 4.5% loan rates. You get an IRR on a property that's 9, 10%, maybe even 8%. That spread can all of a sudden now kick this into becoming a 15 to 20% return on the investment. So make sure and consider financing when you're looking at this as well. Now, one last thing, and this is Terry, you wanted me to put this up. We didn't get through the whole presentation today. Some great questions, and I want to come back and answer any questions for anybody who wants to stick around. The Analyst Pro is available to CCIMs at a discount. I was telling Terry before the call that with the Florida CCIM chapter, and as a thanks to the Florida CCIM chapter, we're happy to discount this to $399 and lock that price in so we don't up that price for at least 2 years. Get in there, take a look at the 7-day trial, email me, let me type my personal email in this as well. But we really have a special relationship with CCIM, with the Florida CCIM chapter. We are thankful for everyone that attended this, and also that Terry and Mary, thank you very much for setting this up. And with that, I'll stick around for any questions as long as anybody would like.
Yeah, we've got a great question here from Mike again, and he wants to know if the software is capable of calculating the costs of an interest-only financing arrangement versus fully amortized financing.
Oh, Mike, thank you for that question. Interestingly enough, literally about 3 weeks ago, we rolled out a new enhancement. And whenever we were constantly rolling out enhancements, but we rolled out a new enhancement to the mortgage section. And I'm just going to go back into the Gabriel's Court and go to the mortgage section because I want to show this and take a little bit more time to show it. And so the new enhancement that we rolled out now allows us to come in and say, am I assuming a loan? In this case, no. But is this loan interest only? And I can say yes. And if I say yes to interest only, then it also comes up with the option of saying, do you want to convert this to an amortization in the future? And so I could say, yeah, I want to convert it. And what year am I going to convert that? Well, I'm going to have an interest only for 2 years. So I'm going to have interest only for 2 years, and then I'm going to have a 20 or 25-year amortization after that. Literally unlimited possibilities. And then the other cool thing that we did, and this can really impact your return, is you can do this. So I can say, okay, we're going to have interest only for 2 years, amortized after that for 25 years. But then I'm going to refinance this property, and I want to refinance it at either a new loan amount or a percentage of the value in the year of refinance. Because remember, we look at what the value is each year. And so then we can say, oh, we're going to refinance this at another 80% loan in year 4. Or year 5 or whatever, and what the interest rate is. And then is it, so it's literally unlimited loan possibilities you can put in the platform. And I'm so glad you asked that question, because this was a greater undertaking than I thought. We actually started this in December and rolled it out just 3 weeks ago. I've had a whole team working on this, and it really is exciting, especially right now with some of the things going on, and people are converting their loans over to interest only in many cases. So yeah, absolutely. We're super excited about this. Makes a big difference on return. So it's fun to go in there and do different scenarios and play with different returns to see, what if I put it on this loan today? Or what if I put it on interest only? What if I refinance in the future? What's it going to do for my return? So it's pretty cool stuff. Any other questions, Terry?
So Todd, we're getting some very positive feedback here and just want to let you know about it. But Rick brings up a good comment. He's talking about real estate taxes based on assessments of property as of January 1 for each year. And the assessments are usually based on direct capitalization and comp sales for investment properties. Oftentimes, the market comps and the cap rates are ahead of any given year of assessments. It would be interesting to see how COVID-19 may affect prices and assessments, since the COVID-19 restrictions were not in effect as of January 1st, 2020, which is this year's assessment date. So there really were no sales prior to the date of value to compare it to. So that's just a comment from Rick. And we also have a good...
And let me comment to that, because that's a great comment from Rick. And so I've got, Texas is a little bit different than Florida, but I received this month all my new tax assessments on the properties I own. And I get a little frustrated. Austin is probably, and I don't want to cross any political boundaries here, but they're very liberal on how they spend their money. Let's put it that way. And I'm very conservative on how I want to spend my money. Socially, I don't care what anybody does, but money-wise, I want to be conservative, right? And so they spend money like it's growing on trees. And so I made the comment to my wife when these assessments came in, and Rick's right. They came in based on January 1. And my comment was, they better enjoy their money this year, because they're not going to get it next year. We're going to be contesting every tax statement as of January 1, 2021. You can guarantee that. So, and what's I'm scared of is the jurisdictions, the lowest local cities and stuff like that are spending all this money, are not going to be adapting their budgets like they need to, because property values have been going up so drastically. Now that's off the beaten topic, but it goes to Rick. I think it was going to what Rick was saying, and it's going to be very interesting.
So we have another excellent question from Robert. And but before I get to that, there's a comment that they do not see your email, so let's make sure we include that.
Yeah, definitely. And hey, everybody. And I put that into, oh, you know what? I put that to all panelists. So let's put it to all panelists and all attendees. Sorry about that. That's my fault. And here's the deal. That special, if you want it, if you want to get signed up on a trial, anything you want, let me know. We can't offer that on the website. We can't offer that to the public. So I can only offer it through directly to you. And through the chapter as a benefit. So email me and I'll have my team get you set up on the trial. And if you want to subscribe at the discount, great, we'd love it. We are only doing that discounted rate for the next month or two, just kind of a COVID thing right now. So,
Todd, we have a good question, constructive question from Robert, and it's about another property type. How deep does the application allow one to drill down into office industrial lease rates, increases, renewal options, improvements, transaction cost, vacant months, etc.? Obviously comparing to Argus Enterprise. So he's looking at Argus Enterprise.
All right, Robert. Man, I love doing deals with CCIM groups because I get the best questions. Let me tell you, this is Argus level for $399. Argus is $4,000 a year and very difficult. I've got a couple of sample properties, and Robert, if you email me, I'm happy to send you a couple of these samples as well. But just going in real briefly and giving you a shot at in this case, a retail center. But you could do this on office, industrial, you name it. But here's a retail center. It's another case study I set up. It's a 3-tenant case study, $16 million, grocery anchored retail center. As you'll see here, I put in the property size as a square footage as opposed to units. So in my apartments, I did units. Here, I'm putting in the square footage, which is what you're going to want to do on your industrial property. Well, what that does in the next screen is it changes the income screen. So if you remember before, I put in a unit matrix. Well, now I'm putting in lease details. And so I put in every individual tenant. And in this case, I put in my grocery anchor tenant. Let me just show you real quickly how I do this. So I put in the lease start. I put in the lease term or the lease end date. I can put in the annual rent for that particular space in a dollar amount or price per square foot. And then you can do custom escalations. So in this case, I said, okay, in the 61st month, it's going to escalate 5%. But you can come in with any month of escalation and then multiple different escalation types, if it's a percentage or if it was a dollar amount, that type of thing. I do that for each individual tenant. Now I come down here and I can put in concessions. So if I have my initial lease and I have 3 months rent, I can give them concessions on that. If I have a tenant improvement allowance, if I have leasing commissions, if I have a net lease. So in this case, this is a net lease. All of the expenses are passed through to the tenant. So I can checkbox each of the types of expenses that are passed on to the tenant, whether it's a net, double net, triple net type situation. So in this case, I have all the expenses being reimbursed to the landlord, and it puts it in that report. Then at the end of the lease, I have a lease renewal probability percentage, just like Argus Enterprise, and what the new renewal rent would be, what the market rent would be, how long it would take to release that. So if I have downtime, how many months would it be vacant? Would I have 3 months I'd have to give? New tenant improvements, renewal tenant improvements, new tenant leasing commissions, renewal tenant commissions. All of it's there. Then the report goes in and does a rollover risk analysis, does my reimbursements, does everything based on the purchase start date and the lease start renewal dates and when the escalations are in there. So if I end up changing my purchase date by 2 months, it changes all the calculations just instantly. And it's really this easy to enter. So I can go into, while we're answering other questions, what I'll do is I'll open a sample report as well to see, Robert, show you an example. But email me and I can send you some sample reports and sample inputs and everything else. You'll love this. If you're comparing this to Argus Enterprise, you are going to absolutely love this.
Todd, we have a reminder from Ron about the reserve fund on reversion, but he adds that he has a project where they're combining an SBA 504 with an SBA 7A, and they have 3 loans to introduce to the analysis. The 504 is 2 loans, and of course the 7A is 1. So his initial question was reserve fund on reversion. What happened to the reserve fund on reversion?
Oh, the reserve fund. So the reserve fund on reversion, what we're doing is we're calculating in our reports that reserve, that $15,000 a year, as our example was in that case, is being spent, and typically that's what we're going to see on most properties. Now, if there's a remaining reserve, you can go in there and actually manually enter an additional amount upon reversion. However, our analysis, the platform as it looks right now, what it's doing is it's going in and calculating and saying, hey, this is being spent annually, and it goes to the cash on cash and IRR calculations for this particular analysis. So we're not automatically doing any reserve fund reimbursement on this, but you could go in and say, okay, in the 5th year, in the 10th year, we're going to have a credit and put that credit in. But you have to do it manually or in the setup.
Todd, there's a question on adapting your presentation for self-storage, and I know you mentioned that as you were going through.
Absolutely. And so again, in self-storage, and I'll mention this, apartments, mobile home parks, manufactured housing, self-storage. I'm just trying to brainstorm the different ones that are usually leased by unit. So when you're leasing by a site or leasing by a unit, what we recommend is going in and instead of saying, here's the square footage of the property, like I'm doing here on this particular property for Robert. And Robert, you can see in here, we got the tenant reimbursements, everything else. What you would do on a self-storage property is go in and say, okay, I've got 20 10 by 10s. And so when I put in 1 bedroom, 1 bath, you could put in 10 by 10, 5 by 10, 10 by 20, 10 by 30s, whatever it is. And then you can put in the market rent for that. And then all else is exactly the same. So it's very intuitive from that perspective. The only caveat is you'd have to enter in the unit matrix 1 line item per each unit type or each unit cost, as you will. So I'm just trying to think of, a park or something like that may have premium units. You may have a higher rate for a premium unit than you would for a standard unit. That could be allowable, and there's no limit to the number of types of units you can put in. You can put in as many different types of units. So based on the size, based on the type, and based on the rental amount would be a unit type for the unit matrix.
And I might comment to participants, you have Todd's email address now. He put it in the chat, and you could actually email Todd with those questions and maybe get a little more detail on the answer than today's time allows for. But Todd, how about one final question if you have time, or I have maybe 2 final questions if you have time.
Sure.
One comes from Rob, and he wants to know, does your software analyze notes on real estate that I might want to sell for a particular yield, or that I may want to buy from hotel holders?
So what we have, we actually have a tool in the Analyst Pro called the Commercial Property Tour and Rating. And if I'm understanding Rob's question correctly, where he wants to make notes and compare different properties, it sounds like he's want to compare yields to different properties or that not. The commercial or the property tour and rating will allow you to come in and put notes, photos, and document that thing. Now, with that said, I would like to note, we're not a CRM system. So we're not trying to replace a Client Look or a Rethink or any other CRM system. That's not what our objective is. We're also not a listing platform or a CoStar or a Total Commercial. That's Rick Orr's job. We store the data for you. We do not sell the data. We do not harvest this data. The information you put in here, our value our proposition and value for our software platform is really in the algorithms we have, in the presentation of the material, and in the simplicity. And one thing I didn't get to today was being able to show you how you can put a whole offering memorandum together in literally about 8 minutes, which would include your demographic reports from Esri that would be in that report. It would include the financial analysis. It would include a flood map, a crime, an environmental. All of that's in there. That's our value. We're going out through API connections, we're pulling the Esri data, we're pulling the FBI crime databases, we're pulling the environmental EPA records, the FEMA flood maps. We're putting all that together into one amazing package for you. And if you email me, I'll send you a sample of that package. I really wanted to show it today, but I didn't want to go over and extend my time and my welcome.
So one final question, Todd. Will there be webinars about some of the other features of your program, such as property reports, maps, and tools? Well, in other words, additional webinars about some of the features that you have.
We are doing webinars on a regular basis, and the best thing to do is contact us, get set up on the trial, and then we'll contact you for every webinar that we do. The thing that you could do immediately is get up, even on the 7-day trial. Get on the 7-day trial. You have access to all of these training sessions, all these webinars. I have one on power of positive leverage. I spent an hour talking about that positive leverage element, creating an offering memorandum best practices, whether you're a buyer rep, tenant rep, a landlord, or a seller. Any of those cases, we go through each one of those scenarios and show a sample offering memorandum and how to put that together. So there are lots of different web sessions already available, but we're constantly doing more web sessions. So these are the recorded ones that we've done, but we're constantly doing additional. And these are more of the training side of things. If you're wanting just help going through and entering, let's say, a lease detail on a tenant, I've got like a 8-minute little video, as well as written instructions on how you would enter the rollover probability analysis and the stuff like that that I just showed, Robert.
So Todd, again, we get the question, will there be a PowerPoint for this webinar? And Todd has said that he will make the slides available in PDF format. And the question, is it cloud-based or standalone? I believe you said it was cloud-based.
Not only cloud-based, but we are actually the first and only true mobile-based commercial real estate analysis platform. And just to show you, so this is my iPhone. And of course, my first app on my iPhone is TheAnalyst Pro. We have a native mobile app on the iPhone, Android, and also on iPad tablets. But every analysis I did, like this Gabriel Court analysis that I did with you in today's session, literally, and it's kind of hard to see over my camera, but you can see it actually generates that report. I can run that report on my phone. I can make any changes if I want to change the price of it, the purchase date of it, rerun that report, and instantly send it out from my mobile device. Everything I just did on my computer, you can do on any device. And we don't limit. We're not like some of our competition. We want you using it on all your devices. We want you using it on your home computer, on your work computer. We want you taking it on your mobile device when you take out and go over where we're allowed to go out right now. But show properties, right? Or be able to present this. So we actually, interesting enough, we designed TheAnalyst, which is a lot different application than what we are today, on the iPhone first. And then we brought it over and created the Pro version and did it on total cloud-based on the computer and mobile. So,
Todd,
great.
One final question, and then we'll cut it off. And we want to thank again our participants, our sponsors. We want to especially thank you, Todd, our administrators that are putting on this fabulous webinar. But we're back to Ron, and Ron still has a question about reserve money. Does the investment of reserve money then increase the basis?
It does not. So coming in, our capital improvement basis, the reserve is really looking at replacements. And so when we're doing replacements, let's say in our case, HVAC or water heaters or something like that, or even a roof, right? It's not adding to, in this case, a capital enhancement. I'm not adding a new pool. I'm not adding you know, a new building, that type of thing. So it does not, in that case, change the basis of the property.
Great. So once again, Todd, great presentation. I look forward to getting on board with you here in the near future. You know, we wish you well. We wish all our participants well. We ask them to maintain social distancing and err on the side of caution. We'd love to see all of you in August at the CCIM meetings that are scheduled in Orlando. And right now they will be at the Rose and Shingle Creek Hotel. So if you haven't already registered, go ahead and do so. It's anybody's guess what the situation will be in August, but until then, stay healthy and stay well.
And thank you all. Thank you, Terry. Thank you, Mary. Thank you for everyone that attended today. It was absolutely fabulous. So,
and thank you, Todd.
take care.
Have a great day.